Welcome to the Deep Dive, your shortcut to being well-informed. We break down complex info, find the key insights, and hopefully keep you engaged along the way. Today, we're diving into ZIM Integrated Shipping Services, specifically their Q2 2025 earnings call. Now, this is a really pivotal moment for them. I mean, they're a huge player in container shipping, and the waters are, let's just say, incredibly choppy right now. So our goal today is to cut through that noise for you. We'll give you the must-know details from the call, unpack what management's really saying, and try to understand their strategy in this really challenging market. You should walk away knowing what's up with ZIM. Okay, let's get straight into the results. And fair warning, it wasn't exactly pretty. ZIM's second quarter numbers, well, they were a pretty significant miss compared to what analysts were expecting. We're talking GAAP EPS, that's the standard profit measure, earnings per share of just 19 cents. The consensus was way higher, like $1.22 to $1.50.
Yeah, that's a miss of over 80%. I mean, that's substantial. You can't really sugarcoat that.
Yeah, exactly. And revenue didn't fare much better. It came in at $1.64 billion. The expectation was closer to $1.81 billion, so about 9% short there. And that's also down 15% from the same quarter last year.
And it goes beyond just the headlines. You know, if you dig a bit deeper, other key metrics also showed some serious contraction compared to last year. Adjusted EBITDA, down 38% to $472 million.
Wow, 38%.
Yeah. And maybe more telling, their EBITDA margin shrank pretty dramatically. It went from 40% last year down to 29% this quarter.
Ouch.
And net income, it basically plummeted. Just $24 million this quarter compared to $373 million in Q2 2024. That leaves them with a tiny net income margin, like 1%. So profitability really took a hit.
Okay, so definitely a tough quarter on paper. When you see numbers like that, you immediately ask what went wrong. Was it just that fewer goods were being shipped, or did their costs go up too, or both?
It was really a combination of factors, and management was pretty upfront about it. The main drivers were, first, a drop in the volume they carried, down 6% year over year to about 895,000 TEUs.
PEUs being the standard container units, right?
Exactly. 20-foot equivalent units, so fewer boxes shipped. And second, the price they got for shipping each box, the average freight rate, also dropped, down 12% to $1,479 per TEU.
So fewer containers and less money for each one. That's a classic double whammy.
Precisely. Hits you on both volume and price. Makes it very hard to maintain revenue, let alone profit.
Right. But here's the part that kind of makes you scratch your head. Despite this really disappointing Q2, management actually raised the midpoint of their guidance for the full year 2025.
Yeah, that was the surprising twist in the call.
They're now guiding for Adjusted EBITDA between $1.8 billion and $2.2 billion. Before, the low end was $1.6 billion. They also nudged up the bottom end of their Adjusted EBIT guidance.
From $350 million up to $550 million on the low end there.
So how do you square that? A terrible quarter, but then increased confidence for the rest of the year? Is this just optimism, or do they see something fundamental shifting?
That's really the core question, isn't it? Yeah. And I don't think it's just wishful thinking. Management argues it's down to, well, basically two big things they've been working on.
Okay.
First, this huge overhaul of their fleet. They've brought in a lot of new, bigger, more cost-efficient ships. And second, they've been really tightening the screws on costs and trying to be much more agile commercially, reacting faster to market shifts.
So they're saying, yeah, Q2 hurt, but we've rebuilt the ship to handle these storms better going forward.
That's the narrative, essentially. They believe these structural changes give them resilience, even if the immediate market conditions, remain tough. They do expect the second half to be weaker than the first and rates to stay under pressure, but they think their baseline is higher now.
Okay, let's dig into that sturdier ship idea then, this fleet transformation. What does that actually look like? How different is their fleet now?
It's quite a significant change. They operate 123 ships, total capacity around 767,000 TEUs. But here's the key bit. About 2/3 of that capacity comes from 46 brand new vessels they got in 2023 and 2024.
2/3 from new builds in just 2 years? That's fast.
Very fast. And these aren't just replacements. They're generally larger, more fuel efficient, and importantly, they're either owned or on long-term charters, which gives them more predictable costs compared to the volatile short-term market.
And is there anything else special about these new ships? Any strategic advantage?
Yes, and this is a big point they stressed. Nearly 40% of their current operated capacity is now powered by LNG liquefied natural gas.
Ah, the cleaner fuel angle.
Exactly. They see this as a major commercial plus. More and more customers are looking for lower emission shipping options to meet their own sustainability goals. ZIM has bet, and this attracts that environmentally conscious cargo.
Makes sense. Are they doubling down on that?
Seems like it. They just announced new long-term charters for another 10 large LNG dual-fuel ships, set for delivery in 2027 and 2028. So they're clearly committed to this LNG strategy for the core fleet.
Okay, that covers the modern efficient side. But in this market, flexibility must be crucial too, right? How do they handle sudden demand drops if most ships are on long-term deals?
Good point. They've balanced it. About a third of their capacity, roughly 250,000 TEUs, is still on short-term charters. This is their flexibility lever.
So they can give those ships back if needed.
Pretty much. Specifically, they mentioned 34 vessels, that's about 134,000 TEUs, are coming up for charter renewal between now and the end of 2026. So if the market really tanks further, they have a clear path to downsize and cut costs relatively quickly. It's risk management.
That seems prudent. So fleet is one pillar. What else are they doing strategically?
Geographic diversification is another one. They've been actively building up their network in Southeast Asia, places like Vietnam and Thailand.
Following the manufacturing shifts.
Exactly. As production moves around, they want to be there. They said this helped offset some of the weakness out of China in Q2. They also highlighted good growth, 10% volume growth year over year in Latin America. So spreading the risk across different trade regions.
Okay, speaking of China, that brings us to the Trans-Pacific. That lane sounds like it's been a wild ride lately. What was the story there?
Oh, definitely a roller coaster. Management talked about a sharp drop in cargo from China back in April when those new U.S. tariff hikes were announced. They had to quickly adjust their network.
But then things changed again.
Right. Then, almost immediately, there was this announcement of a 90-day tariff suspension. And boom, demand surged in May as U.S. importers rushed to stock up before tariffs potentially kicked back in.
Trying to beat the clock.
Yeah. And that surge pushed up spot freight rates temporarily. They noted some of that higher revenue will actually only show up in Q3 because of how revenue recognition works, basically, when the ship arrives.
Interesting timing effect. So that May surge helped, but what about now? Is the strength holding?
Unfortunately, no. Management said the surge was short-lived. Demand on the Trans-Pacific is apparently pretty weak again now.
And no strong peak season expected.
They don't think so. Partly because of all the ongoing uncertainty around U.S.-China tariffs, and also because capacity that was pulled out earlier has now been put back into the trade lane. So maybe demand got pulled forward into May, and now it's quieter. Outlook for the second half seems cautious there.
Okay, so operations of agile, fleet is modernizing, but the market is, well, the market. How's the financial foundation holding up? Balance sheet, cash flow, can they actually afford to navigate this?
That's a crucial point. And actually, their balance sheet looks quite solid. Despite the tough quarter, they reported total liquidity of $2.9 billion at the end of June.
That's a decent cushion.
It is, and they generated positive cash flow, too. $426 million in free cash flow, $441 million in operating cash flow during Q2. Net debt is around $3 billion, which gives them a leverage ratio of about 0.8 times Adjusted EBITDA. That's pretty low, especially for this industry.
Low debt, good liquidity, that definitely helps. What about returning cash to shareholders? Did the low profit hit the dividend?
It did, significantly. Their policy is to pay out 30% of quarterly net income. Since net income was way down, the dividend followed. The board declared just 6 cents per share for Q2, totaling about $7 million.
A big drop from previous payouts, I assume.
Oh yeah, a very big drop compared to Q2 last year. But, the fact they're still paying something based on the policy, even when profits are thin, reflects that financial discipline and positive cash flow.
Right. So putting this all together for someone looking at ZIM stock, how does it fit into the bigger picture?
Well, the stock performance itself tells a story. Over the last year, ZIM has actually given an 8.8% total return if you include dividends. Yeah. But that significantly lags the broader shipping sector. There are shipping ETFs that gained 10 or 11% just in the last quarter.
So ZIM's underperforming its peers.
Lately, yes. And remember that run up of the stock before the earnings? It was up over 11% in the month leading up to the call.
Anticipating good news, presumably.
Exactly. That optimism clearly evaporated when the actual Q2 numbers came out. It shows how much the market is focused on the here and now results, maybe more than the longer-term strategic stuff management is talking about.
And what about the industry overall? What are the big themes affecting everyone?
The whole container shipping world is grappling with softer freight rates and volumes right now. Plus, you've got your big macro clouds hanging over everything. Potential tariffs, U.S.-China trade friction.
Right.
It creates a lot of uncertainty.
And the supply-demand balance.
Still tilted towards oversupply. Lots of new ships are being delivered across the industry. Now, things like the Red Sea diversions forcing longer routes and port congestion, they are soaking up some of that extra capacity. But overall, supply growth is still outpacing demand growth, which naturally pushes rates down.
You mentioned costs earlier. The CFO made a point about industry costs being way up.
Yes, that was a really critical comment. He said overall industry unit costs are materially above pre-pandemic levels. And it's not just one thing.
What's driving it?
It's several things hitting at once. You've got the switch to more expensive low-sulfur fuel, or LNG. You've got higher prices for building new ships and higher charter rates compared to a few years ago. Port handling charges are up after new labor agreements. And because of all the congestion and rerouting, carriers actually need more ships just to maintain the same weekly service frequency.
So it costs more just to keep the same schedule running.
Exactly. Like needing more delivery trucks because traffic is bad. It all adds up to significantly higher baseline operating costs for everyone.
So against that backdrop of rising industry costs, what specifically is ZIM doing to manage its own costs?
They're tackling it from a few angles. The bigger average vessel size up 50% since 2022. That helps with economies of scale per container. The move to LNG, they hope, will be cheaper long-term and avoid emissions costs. Their partnership with MSC, a giant carrier, should bring network efficiencies. They're also working hard to reduce empty container moves. Repositioning empties is a huge hidden cost in shipping. And they're investing in digital tools for better forecasting, pricing, and customer interaction, trying to optimize everything.
It sounds like a constant battle on multiple fronts. So for investors, it's this tension, right? Near-term pain versus long-term potential.
That's exactly it. The market slammed the stock after the Q2 miss, focusing on the current weak rates and uncertainty. Management is trying to point beyond that to the structural upgrades, the stronger balance sheet, the raised guidance.
What could change that negative sentiment?
Well, a few things could act as catalysts. If freight rates stabilize or start to recover, that would be huge. A clear resolution on the tariff situation, especially between the U.S. and China, would remove a lot of uncertainty. Or just generally better global trade conditions. Any of those could make investors look again at ZIM's potential with its modernized fleet. But until then, it feels like a show-me story.
All right, let's switch gears. It's time for our not financial advice segment, where we toss around a perhaps slightly unconventional idea based on what we've heard. So ZIM gets hammered post-earnings, trades at a discount. Management sounds confident, almost defiant about navigating turbulence. The market's clearly focused on the near-term gloom. Could there be a contrarian play here for someone willing to embrace the uncertainty?
Okay, purely as a thought exercise, right?
Yeah.
Not advice. But given the situation, high volatility, strong opinions both ways, a company in transition, one idea could be to play for a big move in either direction, using long-dated options.
Options, okay. Like buying calls or puts?
Actually buying both, a long straddle, but with a twist, and going way out in time, maybe to the January 2027 expiration.
2027, that's a long time out. What's the twist?
The twist is how you structure it. You'd buy out-of-the-money calls, say aiming for a $25 or $30 strike price. These would capture massive upside if something really positive happens, like a major geopolitical resolution, a tariff rollback that sparks huge demand. That's where ZIM's leverage could kick in.
And the puts.
You'd buy out-of-the-money puts too, but maybe closer to the current price, like $10 or $12 strike.
Yeah.
These act as your insurance policy. If things go really sour, deep recession, trade war escalates the puts, protect against a total collapse.
So you're betting on a huge swing up or down over the next couple of years.
Exactly. The core idea is ZIM is super sensitive to global trade winds. If things unexpectedly clear up by 2026 or 2027, the operational leverage from that new fleet could make the stock explode upwards. The calls capture that. The risk is things just stay bad or get worse. The puts limit the damage in that scenario.
And the long time frame gives it all a chance to play out.
Right. It lets the current stress test run its course. It's fundamentally a bet on extreme volatility, but maybe with a slight upside skew because of that modernized fleet and decent balance sheet that the market seems to be ignoring right now. It's definitely not for the faint of heart, though. Pure speculation on volatility.
Got it. A very contrarian thought indeed. Okay, let's wrap this up. To recap the ZIM situation, Q2 earnings were a clear disappointment, big misses on EPS and revenue, and the market reacted negatively.
Yep. But despite the undeniably tough market conditions, falling rates, trade worries management projected confidence. They highlighted their transformed, more efficient fleet, their agile strategy, and they even raised the midpoint of their full-year guidance. A bit surprising, frankly.
So the company's financial strength and strategic moves are really being put to the test right now. Investors are clearly watching for any signs of freight rates firming up or some clarity on the global trade picture before maybe reevaluating the stock's potential. It's all about whether that new fleet can truly navigate these rough seas.
And just to reiterate, everything we've discussed here is purely for informational purposes. It is absolutely not financial advice. You should always consult with a qualified financial advisor before making any investment decisions.
Absolutely. Thanks for tuning in to the deep dive. We hope this look at ZIM's earnings call gave you some valuable insights into the complex world of container shipping right now. Here's something to think about. What weighs more heavily in your mind for ZIM's future, the internal improvements like the new fleet, or the external pressures from the global economy and trade? We'd love to hear your perspective.